Hey gang, in our last video we introduced how to properly calculate depreciation expense under the straight line method. In this video you're going to learn how to properly account for depreciation under the units of production method. But first, facts. So, we already know that there are 4 depreciation methods in which a company could choose to properly calculate the depreciation expense at the end of the year for a planned asset. In this video, we're going to discuss the units of production, which in my opinion is probably the second easiest one to calculate. So, unlike the other 3 depreciation methods that uses the life of the asset as its base for calculation, units of production is basically a unique one because of the fact that it does not use years as a base for calculation. It uses the amount of usage. Henceforth, units of production. So basically, under the units of production, the particular asset will only get depreciated based on its usage from the year. And that's real accurate if you really think about what depreciation is supposed to do. So in terms of the calculation, the numerator is similar to the straight lines formula. It is the depreciable cost of the asset, which basically means cost of the asset minus the salvage value. The denominator, instead of it being years, will be what? You guessed it, gang. Estimated total usage of the asset. And so once that particular amount is calculated, that's going to give us a rate in which we're going to apply to the actual usage of the asset per year. So without any further ado, let's take a visualization of an example of how to properly utilize units of production, as well as learn how to calculate the table under this method. To the board. Okay, gang, so we are going to take this illustration and calculate the depreciation expense as well as the table under the units of production method. So on January 1st, It's a Joke purchased a private jet for $4 million. It's a Joke expects the jet to remain useful for 6 years, 3,700,010 miles total, and to have a residual value of $4 million. The company expects the plane to be flown in year 1, 1,000,000 miles, year 2, 200,000 miles, year 3, 500,000 miles, year 4, 0 miles, year 5, 2 million miles, and year 6, 10 miles. Compute the depreciation schedule assuming the units of production. So, in terms of the first year's units of production depreciation expense, the calculation is similar to the straight line method, gang. It's simply going to be your depreciable cost, cost minus salvage value, divided by the total estimated units instead of the years. And so we know that our total cost for the plane is $40 million, the salvage value is $4 million, and our total estimated miles is 3,700,010 miles. If we calculate it correctly, that should give us a total of $9.73 per mile. Meaning that, gang, for every mile that this particular plane is flown, we're going to depreciate the asset's cost by $9.73. Therefore, for the first year's depreciation adjusted entry, we're going to debit depreciation expense, and we're going to take the amount of time that it was flown, which was 1,000,000 miles, and we're going to multiply that times $9.73. which will give us a total depreciation expense of $9,730,000. And obviously we're going to also credit accumulated depreciation for the same exact amount. And so that's that, gang, for the first year's depreciation expense. But I like to show you how to create the table so that we can watch the depreciation take place throughout the entire life of the plane. And so here's the units of production's depreciation table. And I want to let you guys know that each table is different depending on the depreciation method. So for the columns for the units of production, the very first one, because this is based on usage and not time, will be the units. And so for each year, you report all of the particular miles flown for the plane. The next column would be the depreciation rate, in which we've already calculated. And what we're going to simply do is multiply the units times the depreciation rate in order to get the depreciation expense for each period. And so this will conclude the depreciation expense for all of the 6 years. And in order to calculate the accumulated depreciation, we're going to add the depreciation expense as the time proceeds. So for example, for the first year's depreciation, our accumulated depreciation will be the exact same as the depreciation expense. But when we move on to the second year's depreciation, we must add the previous year's accumulated depreciation to the current year's depreciation expense. So if we add the $9,730,000 in the previous year's accumulated depreciation to this year's depreciation expense of $1,946,000, that will give us our new accumulated depreciation of $11,676,000. And we will continue to do that throughout the following years as such. Now, one thing I want you guys to notice, gang, is that whenever we're depreciating an asset, we cannot depreciate it past the salvage value. And in this illustration, it tells us that the plain salvage value, after it's fully depreciated, must be $4 million, which means that the book value at the end of the life of this asset must also still remain $4 million. And so if you pay attention to year 5, and notice that our depreciation expense is $19,460,000, if we add that to the previous year's accumulated depreciation, our new accumulated depreciation at the end of year 5 is $36 million. And so that basically means that we've fully depreciated the asset in year 5. So what happens in year 6? Well, since we've fully depreciated the asset in year 5, year 6 will not get depreciated. Why? Because we can no longer lower the value of this asset. The accumulated depreciation cannot go higher than $36 million. And so in terms of calculating our book value, gang, we always know that book value is simply cost minus accumulated depreciation. And so for year 1, our cost of $40 million, we subtracted from the accumulated depreciation of $9,730,000, and that will give us a total of $30,270,000. And we will continue to take the cost and subtract it from the current year's accumulated depreciation in order to calculate the following. And so as we can see at the end of year 5, our book value is equal to our salvage value, which again verifies that it can no longer be depreciated. So therefore, the same book value will be carried over at the end of year 6. So there you have it, gang. A perfect illustration of how to properly calculate depreciation expense, as well as create the table for the units of production method. Hopefully that light bulb was burning upstairs and you actually caught the punchline. As always, gang, I appreciate your time and patience that you share with me, and I look forward to seeing you soon. Thanks.